Hey everyone, thanks so much for joining us. I'm Jen Rogers. Today we're going to be exploring how U.S. municipal bonds can enhance your clients' portfolios. We have two great guests with us and one poll that I want to point out. You can check over on the right side of your screen. We'll incorporate that if we can get your answers in there. Joining me right now, though, I've got Michael Kashani. He's Global Head Portfolio Management at Goldman Sachs Asset Management, and Laura Levenstein, Chief Risk Officer at Build America Mutual. And remember, go to that poll and we will try and get it in. And also in the chat, we want to get you engaging as much as possible. So put some questions in there that will really help inform our discussion, and we'll incorporate it as much as possible. So Laura, I want to start with you. I mean, interest in overall has really grown steadily in recent years. What trends are you seeing right now in the volume of green bonds and sustainability bonds globally and also in the muni market?
Thanks, Jen. So I was going to focus a bit more just on the muni market because that is the area I'm most familiar with. But I thought a little bit of background may be helpful. What we're seeing now is U.S. municipal bonds are gaining ground as an investment option because U.S. municipal bonds combine low risk and a positive environmental and/or social objective. And these include both social and green bonds primarily. The standards in the U.S. municipal bond market for green and social bonds are the International Capital Markets Association Social Bond Principles and Green Bond Principles. Both of these standards were updated in June of 2021 and are designed to encourage issuers to improve transparency in 4 key areas. And that's really detailing the use of proceeds, explaining the process for project selection and evaluation, adopting controls to make sure the money raised flows to the qualifying projects, and post-issuance reporting. Under the green umbrella, investors have a lot of options for how to deploy their capital. They can invest in a range of products. Some of the specific approaches include investing specifically in projects that reduce carbon emissions, and others are projects that have a measurable social impact for underserved communities. With respect to underserved communities, it is worth noting that social bonds, while they are targeted towards underserved communities, they are not exclusively for those communities. So social bonds can be bonds that serve an entire community with segments of which are either underserved or marginalized communities. What we see mostly in the municipal bond market in terms of green bonds is bonds for clean and transportation, electric and hybrid public rail and transportation systems, bonds for sustainable water and wastewater management. These are bonds for infrastructure for clean and drinking water, wastewater treatment, sewer overflow elimination, flood mitigation, and drainage systems. And then bonds for green buildings, which are buildings that may be for state and local purposes like city halls and police stations, but that meet internationally recognized standards. So what are we seeing in terms of the market now? I'm basing the numbers that I have on numbers published by Environmental Finance. There are a number of different parties that publish numbers about the market over, throughout the year. The green bond market, though, did reach an annual record of approximately $295 billion in 2020, and analysts are forecasting another record year of about anywhere from $310 billion to $500 billion. The U.S. does remain the largest market for green bonds, coming in at about $61 billion in 2020. Germany was second with $41 billion, and France was third with about $37 billion. In the U.S. municipal market, the largest issuer was the New York Metropolitan Transit Authority. The MTA issued about $4 billion in green bonds in 2020. We do expect, in the municipal market in particular, the U.S. municipal green bond market to grow in 2021. This is driven by a number of factors, including interest in U.S. municipal bonds by a broader group of investors, including international investors. And that's driven by an interest in green bonds and the higher yields that are available in the U.S. municipal market. Year-to-date yield on municipal bonds was about 1.2%, which was higher than in any other U.S. fixed income market. So that was the U.S. municipal market outperformed the other markets. We do expect growth in the green bond market to be also driven by just a renewed focus on climate change and the aging state of the nation's infrastructure. The social bond market is smaller, both globally and in the U.S. In 2020, we saw an enormous amount of issuance driven by COVID-related initiatives. So a lot of social bond issuance was driven by COVID in 2020. About 60% of the total issuance was probably COVID-related in one way, shape, or form. In the U.S. municipal market, the largest issuer was the Massachusetts School Bond Building Authority, which issued about $1.5 billion in social bonds in 2020. Projections for 2021 are about 150 to 160 billion. So we're not seeing an increase over 2020. We're not seeing a big fall off from 2020 either. And I think this is, again, largely driven by heightened focus by investors and fund management firms on ESG and global social issues, as well as interest of more broader group of investors globally. One thing I think that is worth noting, which I think has enhanced both the green and the social bond markets in 2020, is more and more social and green and sustainable bonds are aligned with one of the United Nations Sustainable Development Goals. So there are 17 Sustainable Development Goals. In 2020, about 63% of all bonds issued in these markets were aligned with a UN Sustainable Development Goal, one or more of those development goals. I think the alignment provides further comfort to investors that they're buying legitimate green, social, and sustainable bonds. And so that's sort of where we see the market going in the next year.
Laura, I think that really helps kind of set the table here, and to bring Michael in. Look, this market has evolved a lot. It has changed. I mean, Laura just gave us, it's a laundry list now of all these different options that are out there. Given these trends that she talked about, Michael, how do investment managers best identify, green, social, and sustainable bonds for want to add exposure, given really the broad scale now of how many options are out there?
Having me, very happy to be here. I think the first level is due diligence. So as an asset manager, our clients expect us to do due diligence and look that bonds following principle, the ICMA, ICMA, green and social bonds principles, which the broader fixed income market follows when labeling. And so many of them have done that, and we have labeled green, social, sustainability bonds. Whether something's labeled or not labeled, it's incumbent upon asset managers to do their due diligence. And actually, we see unlabeled impact in the muni market. There's, especially on the social side, when we speak to clients and they have the ability to think about a broad multi-sector approach, so not just munis, but thinking about what munis do, and they have the ability to fund the construction or expansion of a K through 12 elementary, K through 12 school in an underserved community, and it's not label impact, they're scratching their heads as to why. And so as long as we are transparent and clear with our clients and give them that ability to dictate, do they only want labeled bonds, or are they giving us the ability and trust to do that due diligence and find that unlabeled market, which is especially in the muni market, given what it's hopefully there to do, it really is set up to have broad impacts across green, social, and sustainability themes.
So, Laura, just to take that a step further on the labeled versus the unlabeled, and also this, you touched on it as well, the dual goal here for investors of making money, but also having an impact, and the standards and the transparency. You're talking about the UN here, but who sets and what qualifies exactly as a green bond or a sustainability bond?
Well, there's several levels of sort of authentication, as Michael referenced as well. Label green bonds and label social bonds mean nothing more than bonds that are either self-labeled by the issuer or labeled by a third party as being eligible to be called social or green bonds. Most of the bonds in the green bond market and the social bond market now are being labeled by a third party. And that, I think, is happening because third parties really give investors comfort. They provide proof of legitimacy that they are true green bonds or social bonds. They are driven by an awareness that there's more greenwashing in the market, so there's concerns about identifying bonds as green that aren't, and also by the fact that issuers don't want to assume the liability for self-labeling their bonds. They'd rather have a third party do it. And so a third party can provide an external third-party independent review. Those can include second opinions, they can include CBI certifications, they can include green ratings, or any other third-party type of assurance. In 2020, about 90% of the bonds issued in the green bond market were subject to an external review. The number is much smaller, I think, as Michael alluded to, in the social bond market. The green bond market, most of the key providers of third-party reviews are relying on the green bond principles and some of the CBI initiative standards climate bond initiative standards to sort of establish the standards they're going to use to determine whether or not a bond is eligible to be called green. In the U.S. municipal market, BAM, the company that I work for, is actually the largest provider of external verifications in the green bond market. And we have a Green Star program, something we've labeled Green Star program, where we have developed our own standards. Our standards are aligned with the green bond principles issued by the ICMA. We are a recognized observer of the ICMA green bond principles. We are an approved verifier by Climate Bonds Initiative. And in 2018, we introduced our own standards, but those are aligned with, again, the internationally recognized standards. To date, we've identified as green bonds or Green Star bonds about 175 bonds, and it's about $2.5 billion in par. That's just in the U.S. municipal market. I agree that on the social side, there's been less development with respect to social bonds in the U.S. municipal market. So there's been less work done in that space. I think one of the hangups was, how do we define target population, and does a project that provides services to a broader population qualify as a social bond, in that a target population may be a subset of that?
So, Michael, I mean, there is the one side that, we're just talking about with Laura, evaluating, labeling, the transparency around this. There's also the part for investors to think about returns. And do investors need to think about sacrificing performance at all to invest in municipal bonds that target a positive impact? Is that something that they need to, make sure they can get their head around?
Sure. It's the first question they ask, the second, and the third. So very important question. Think about the municipal market. We have approximately 50,000 issuers in the market. We have nearly about 1 million different securities. There's a lot of flexibility and variability. And depending on how deep a client wants to go to, now you can have portfolios that have all impact, that lean towards a certain percentage of the portfolio being impact, that maybe have some areas that they don't want to invest in. So depending on where you are on that scale, we don't believe that you need to meaningfully sacrifice returns to hit areas of impact. It also depends on how broad you allow your definition to be. And I think that ability to work with our clients to know how can we get their specific, what they really care about into the portfolio, those views, those ideals that they have into the portfolio. And sometimes we might have to note to them that they are very, I'd say, supportively ambitious, and we might need to temper that a bit with the realities of performance, since most clients want to do good, but obviously usually have some directive towards putting performance as their primary objective.
And Michael, just to follow up there, I mean, you make it abundantly clear it's not a one-size-fits-all solution. Look, people are coming to this with different needs. They have different risk tolerance in here, different goals. So what are some of the different investment options for clients looking to access this market? When you start to have those conversations, what do those baskets look like?
Sure. So if we think about the broad market, there are funds, there are pooled vehicles that offer this. Within Goldman Sachs Asset Management, we offer a separate account product, so allowing our retail client base to really customize their portfolio, not just for ESG factors, but for broad factors. Now, ability to bring in both external and internal data points and construct a portfolio that meets those investment objectives, but then also leans into, we call ESG enhanced objectives as well. Really, where can they extract, really look at the bonds in their portfolio they may have been investing in for quite some time, but never asked the question of what is this actually funding? What is it? What are my investors paying to do? And being able to see that visually. And I think the ability to tie an investment to a project and be able to visualize that, and it's local. And I think that ability to localize the impact, especially across, we talk about green social, that they're differentiated. Many times they're one and the same. The ability to bring economic and environmental justice and transparency and equality across a portfolio. With that 50K amount of issuers, there's a lot of opportunity to find some really interesting stories.
Laura, you're nodding yes. So when you're listening to Michael there, what's got you, agreeing?
Two things you said, Michael, really resonate. One, I mean, just if we look at our portfolio as an insurer, we think at least probably 20 to 25% of the U.S. municipal market would qualify as green, outright green, just given the projects that are being financed. And again, those are transportation projects, energy efficiency projects, lots of water treatment, water and sewer treatment, flood mitigation, lots of things related to climate change mitigation and adaptation. So we're seeing a lot of projects on that side. The social side, I agree as well. There's a lot of overlap between social and green bonds. And so if you look at the criteria, particularly the green bond principles and the social bond principles, some of the eligible projects are the same. I mean, literally the same projects, whether it be providing education or essential services. So there is a lot of overlap there as well. I think the green bond market has just been clearer for people in the municipal market to identify with, because you can take a project and say, okay, this is leading to this outcome. And again, as I mentioned, I think that the most recent issuance or principles issued by ICMA on social bond principles has clarified what it means by target population and what it means to be a qualified social bond, and that you can issue bonds for an entire school district, for instance, and build a K through 12 school. And that's providing a service community. A portion of that community is probably underserved. A portion of that community may not be maybe below poverty. A portion of that community may not have fair representation. That can still be a social bond, even though a portion of it is not in that target population.
And Jen, I might add that, that, because Laura brings a good point of disclosure. One of the key areas is engaging with the issuers on providing information. If anything, we're helping to try to make their bonds more marketable and have a wider audience. So we've actually had a very positive reception to engaging on providing more information, even without the label, because it provides that opportunity for the issuer potentially to reach a broader base of investors.
I want in the room that we do have a poll question out there. It's on which ESG sectors within the municipal bond market are the most compelling for your clients. If you answer that, we can try and in there. And if you have a question, put it in the chat as well. Michael, one thing, Laura said she's focused on the municipal market in this country. It is kind of interesting because for years, I think munis were more local in nature and investment decisions were often driven by tax advantages here, but we've kind of gained attention from international buyers. Is that something that you see continuing? Is this now a big cross-border play?
I think it would be fascinating to the audience to know that whether those clients be located in Europe, Asia, the Middle East, people are paying attention to the U.S. municipal bond market, particularly with the growth of the taxable market. And for those who don't know, the taxable market very much treats municipal bond almost like a corporate bond. So different investors, especially if they have the ability to invest in a cross range of assets, can think about municipals alongside corporates. And when those investors, they're very unfamiliar with the municipal market, not surprisingly, I could use the term they're shocked, pleasantly shocked about the potential for impact across those sectors. And so for some of the multi-sector fixed income portfolios that we manage that have that green social sustainability focus, they want the U.S. municipals to be a big part of that. And we've had corporate clients in the U.S., foundations really across the world, as well as pensions, sovereign wealth funds, utilize either, I would say, a significant portion of the taxable muni market or even maybe a bit of a smaller one. The other area of the institutional client base are insurers. Insurers can also benefit from tax-exempt municipal bonds in some instances. So they're also very focused on that impact. So the ability for it to just move away from, I'd say, the retail investor base shows, which is a very important investor base, but shows the power of this market, especially if individuals and companies like Laura's can do the good work of trying to really highlight the impact that these issuers are trying to have on their communities.
And Laura, we've got just about a minute left here. Something that we talked about earlier that we just had a question on is the advantages for labeled bonds versus non-labeled in this space. How do you? What are the advantages?
Well, I mean, the advantages are just legitimacy, concern about greenwashing, at least on the green bond side. Issuers have some concerns about self-labeling, because if they label their bonds and then for whatever reason in the future there's some change or a different use of proceeds and they mislabel the bonds, that's a material event. They would have to disclose that. So there's some liability there as well. So I think investors do like label bonds. As Michael said, a lot of firms do their own assessments, do their own due diligence, but to have an external label on top of that is a level of comfort.
So really, it's fascinating to see how this market has evolved and how it's really growing and changing and what's being added to it all the time. Again, we still have our poll out there. Give us some feedback on that. And Michael and Laura, both, thank you so much.